slide. Yeah, so my background's in loan syndication, but don't hold that against me. I think I'll make a point about Brad's comment, actually, because for the first time in a long time, we actually are using that corporate bond market and the pricing that's going on in that corporate bond market as a pricing benchmark for the loans. So we will often have looked at USPP spreads, punchback, and where other trades are going on, but we're actually looking at that market. So that's an interesting development for me. I think pricing for that 7-year stuff is kind of on the mark. So I'm not necessarily talking about markets today because I could ruin about 3 of the future presentations if I went through in detail how these markets work. But unrated debt issuance is an interesting topic and something that, so my team, obviously, now we have a split of our origination functions between rated and unrated clients. So this is a little bit close to my heart. This is not a discouragement for getting a public rating and going to those public markets either, because it does create a lot of liquidity. But I think there's an acknowledgement for a lot of borrowers that doesn't necessarily make sense. And what we wanted to do today was spell out what that looks like, what it looks like as an unrated borrower, some of the markets, and a bit of a strategy around how we think about approaching doing a financing for an unrated borrower locally. So as I said, there's a lot of reasons to get a public credit rating. However, regardless of whether you have one, there's still actually really good access for borrowers that aren't formally rated. So who are we talking about here? Typically we're talking about triple B and double B rated borrowers locally. Single B, as Craig pointed out, the TLB and some of the other global markets actually do provide really good terms, conditions and value. If you go up into the high triple B and A range, you're shortchanging yourself if you're not getting a public rating and going and looking at the public bond markets, to be honest. The debt requirement, we're looking at companies that typically have a requirement up to about $1 billion. Where people cut off and get a public rating and go broader, it depends on the borrower to a certain extent, but at $1 billion we think it starts to make a lot of sense to start diversifying away. Also making a comment around the minimum issue size for some of the public markets kind of drives you towards that $1 billion mark as well. So investor characteristics. So you'll already have bank facilities. I mean, just about everyone in Australia has bank facilities with a range of different banks. So clearly that's one investor, and we'll talk about the loan market in a second. But the investors are going to be sophisticated. They're not going to have the diligence provided by a credit rating or the oversight provided by a credit rating. They'll have internal credit review processes and review capabilities. So this is not the type of investors are going to do they're going to want to understand the business, right? They're going to want to partner with you and understand in a lot of detail how the business works. That can be achieved through a marketing process for a lot of these markets, not dissimilar to the one that you would do with your banks anyway. So the investors specifically, they're going to have multiple credit teams. We've heard about public market. A lot of the investors in the public market have private credit teams and portfolios. They've got ex-bankers working in them, so they're prepared to sit down and do the work on project financing, resources, infrastructure and corporate type transactions. I made the point about without the public rating, the diligence will be required. And the diligence will include typical stuff that you have on bank processes. So they're going to look at financial leverage, they're going to look at the industry as a whole, peer analysis, benchmarking, they're going to look at management capability, and there'll be a degree of diligence around that as well. Format, both loan and bond markets are available locally without a rating. So the public market is one of the markets you can get access to. We'll go through a few others shortly. Best efforts arranging as usual, but NAB and a couple of the other major banks definitely can construct underwritten offerings for a lot of the markets we're talking about, either via bridge products or directly underwriting the loan formats that we will talk about. So the format is typically pretty flexible for an unrated borrower as well. So why is there a larger opportunity right now? And the next slide, when we talk about the breadth of markets or the number of markets that are available, the slide will maybe make a little bit more sense, but what we have seen is domestic money seeking alternatives to other types of fixed income exposures. Public bond markets are great. You have rated companies, but that's not enough. We've seen the bank market here last year was 99 to 100, I think, depending on the provider, almost $100 billion. So from an investor's point of view, you've got to look at that and say, how do I get access to some of that? So the domestic money is coming to us in certain pockets, actually talking to us about the opportunity to invest in loan format. You've also got self-managed superannuation fund money and retail money that is full of bank exposure at the moment, to be totally honest, and really interested in looking at corporate credit on a triple B, double B type basis. Pricing at the moment, as I mentioned at the start, is actually quite comparable across a lot of these markets for the first time in a long time to global markets when you're looking at the swap back cost. And the investors particularly are seeing the opportunity to participate in funding corporate Australia, which we haven't had that dialogue or discussion for quite a period of time. On the borrower side, there's not been a lot of change. We continue to seek diversification, as Brad indicated. Longer tenor to manage refinance risk is a priority for some. Diversification is a priority for some. Some people are always going to look at cost of capital and look at doing the shorter type deals. We are actually seeing a similar trend in those areas, but where we have seen a difference, particularly in long-dated funding, so the 5, 6 and 7 year funding from banks is starting to become really expensive in the last probably 6 months. And I think that is the first signs of starting to see the Basel III regulatory environment starting to kick in a little bit. So if you're looking at getting 6 or 7 year funding from a bank, it's not as attractive as it would have been in the past. 5 years, competitive tensions are actually making it quite attractive. But I think there's a trend there. There's a trend going forward that's going to make it more difficult to fund yourself with banks, and I think a lot of borrowers are cluing up to that and starting to prepare for it. So is there markets other than the bank loan market? Yes, there is, and they give tenor, they give light terms, they give choice and options. So if you look at, this is my point, I could talk about all of these for a long time, but we're not going to. So the bank loan market, obviously, institutional loan market was mentioned before and has some interesting characteristics. The ASX listed bond market, both listed and unlisted, so the sophisticated or more highly knowledgeable investors, particularly looking at putting capital into corporates in the US private placement market. So all of these markets are clear options for someone without a rating, notwithstanding a rating does actually help get liquidity and maybe drive a pricing outcome in a few of them. So the bank loan market, I won't go into this in a lot of detail because I think there is going to be a presentation on this. Brad mentioned the volume in the last quarter of last year. It was significant. Corporate Australia returned to refinance all of their loans in this market. The tenor options, the tenor chart down here, the long end is largely driven by project financing. Corporate deals are in the 5 year bucket still. So why is this attractive to unrated borrowers? I'm sure I don't need to tell anyone in this room this. It's flexible, it's revolving, the pricing is relatively attractive, and it's highly liquid with banks. Something a little bit different that we have seen over the last few years, though, is the institutional term loan market. So this is effectively a subset of the syndicated loan market. And we're having continual dialogue with super funds who are interested in investing in loan format. Why would you want to do loan format? You have extra diligence that you get over a public process often. You've got a bank IM and a whole stack of additional information that you often wouldn't get through the public bond processes. You get security, or you get terms and conditions that are pari passu with the banks. And you get access to the credits. If you're having the banks structuring these deals for themselves in the 3, 4 and 5 year buckets, it's not very hard to actually bolt on a 7, 8, 10 year option to that to give yourself some flexibility and some diversity of funding in terms of tenor. So what are we hearing from investors? We're hearing 7 to 10 years. Why are we in that area? The focus is on getting value for the additional cost. So this will cost more. You have to be able to take a view that the tenor is valuable to you on a cost of capital basis. If that's not necessarily the case, then some of the longer tenor options clearly won't work. But we are seeing people do bond trades, so it's clear that that is a focus. So the fund's telling us we've got a minimum yield requirement in the 200 area for our investments, so we're looking to push out the tenor, 7 to 10 years. They want a bullet, they want to be fully invested. They're not that interested in revolving or prepayable credit, so you're also seeing soft call protection added into some of the loans. So what do we mean by that? We're saying there's a penalty for prepaying it early. You can do it. There's no make whole. It's just that you're going to pay the front end cost you would have otherwise paid to a bank, at the point that you make that prepayment. So the investors will get paid a premium for having been refinanced out. It's pari with the banks, so you're going to have similar terms and conditions. We're not talking about covenant light here, so this is not the term loan B for Australia or anything like that. This will have maintenance covenants. They're going to be consistent with the banks. The funds that are investing in these and the teams that are investing in these loans are largely ex-bankers. They know the documentation, they know the processes, and they will want the comfort of having those maintenance covenants there. The contra to having that is that the investors will understand the consent process and understand having to work with the borrowers to actually to make the format work. And we're talking about super funds and banks as well, potentially. So some of the Asian banks have got a capability with a longer tenor. So why do we think this is attractive to unrated borrowers? Flexibility. So a loan format creates flexibility, longer tenor that we're not getting from banks. It's available in Australian dollars, unlike some of the other markets. And you've got credit-intensive investors who can actually sit and understand the business and understand the story around why the company is structured or has particular parameters. So ASX listed bond market, I say listed, some of these bonds aren't necessarily listed, some of them are unlisted for a smaller amount. This is the retail superannuation money. So on the corporate side, there's been a number of transactions. It has been small in the financial transactions, so this has been dominated by financials, so Tier 1, Tier 2 equity type issues for banks. But the investors are telling us, through the channels that we've got, the investors are telling us they want access to corporate credit if they can get it. So there has been a few deals, and there's two actually coming up in this quarter that look like coming to market in this quarter for pure corporate names. What does a deal look like? If you don't want to list it, there's an overhead with listing it in terms of cost and diligence. If you don't want to list it, you're looking at $75 to $100 million transaction with high net worth sophisticated investors. If you do want access to the additional liquidity, you're looking at getting a listing. It does add something to the extra cost, but where you get that back is in the longer tenor. So you can do a 10-year format bond here with relatively light terms and conditions. The investors aren't as interested in the terms and conditions of the bond. They are interested in making the investment and having the money invested at a yield type basis. So some of the structuring that we've seen for some of these bonds has been relatively light on the terms and conditions. Some of it is subordinated to the bank structurally, so you'll be seeing unsecured deals, particularly in the unlisted, more sophisticated investor space. What that gives us the flexibility to do is manage the capital structure without having formal intercreditor arrangements in place. The cost of an unsecured deal might be a little bit more, but when you look at the overall cost of doing your funding, when you're going to get a benefit on your leverage ratios, you're going to get a benefit on your bank pricing from having that piece of subordinated capital in there and deleveraging the business, you end up oftentimes ahead. So the way we think about this market is very much in that guise, a complementary market to your bank deal that comes along with your bank financing. Another feature of this one is just down in the bottom. Why it's attractive is it leverages a brand profile a lot of companies have worked very hard on as well. So the channel marketing that is done here for this type of product is a brief information package that goes out through brokers, and broker recommendations actually provide a lot of the volume into this. So the transactions need to be easy to understand, simple, basic, vanilla. We're not talking about hybrids or complex structures here. And with a good, strong brand profile, you'll get good attraction from the investors. And the USPP market, again, I think we have a presentation on this later, so we won't go into a lot of detail. This has been the favourite of Australian corporates. We say it's an unrated market, which it is, although a lot of the issuance that goes there is actually done by rated borrowers. The attraction typically has been the format of the lenders, very much a relationship focus. The long tenor is really unmatchable locally in the public market or even in the private markets. We talk about doing an institutional term loan or an ASX listed bond. They don't go beyond 10 years typically. These lenders will go out to 10, 12. In fact, the sweet spot is 12 years. So this is the tenor market that fits into most capital structures. And if you think about the capital structure being tiers, the markets we've just talked about are reflected here on a maturity profile. So the way we think about when we're trying to solve a problem for a borrower in terms of a financing, there's very clear buckets of tenor and where the markets will fit in. The bank loan market will kill anything short term. The banks are nimble, they've got cross-sell to offset the cost of debt with that institutional or bond investors just don't have. So in the short end, as Brad indicated, we recommend going to bank debt markets typically, unless there's a massive task that needs diversifying away. So that format, as I said, is highly flexible, it's got strong liquidity, it's got attractive price. What are the shortcomings? Short maturity. A lot of people seem comfortable managing that. There's no problem if you are comfortable refinancing that package every 3 or 4 years, because the reality is you never get the 5 years out of your deal. But you've got regulatory and flight risk in this market as well. So the 4 domestic banks very firmly stayed in this market in 2009 and 10. The cost of capital went up. I think there's no doubt about that, but then the cost of the banks went up as well. Some of the foreign banks, though, we can't say the same story about. So some of the European banks really had difficulty in their home markets and had to release capital by, I guess, not assisting domestic corporates. So there's a bit of risk there. The big risk here on the outlook is really regulatory risk. So if you're thinking about refinancing risk, it's about what the regulation looks like in 3 or 4 years' time. And if there's not an understanding about Basel III, then it's something to have a chat to your bank about, because the liquidity ratios and the leverage ratios that are going to be applied to the domestic banks will start having an impact, and cost of funds will be impacted in parallel to that. When you're looking in the 5 to 10 year band, there is some options if you're unrated. Domestic term loan is viable. We are talking to investors and we have got feedback indicating that there is interest in funding corporates. It's not going to be at the bank loan pricing. And that's just going to be the reality. It's going to be at a premium, but at the moment it's not at a significant premium. And ASX listed bond format is there as well, providing good liquidity in terms and conditions. What I did want to draw attention to on the bottom corner is, on the longer tenor, I want to pose the question, because while we say there's no domestic markets necessarily plus 10 years, I would challenge everyone to think about domestic term loan and ASX listed bond markets and the public market as well. In terms of format, if we continue financing with banks, will we ever test those formats in the 5 to 10 years where we are getting the feedback? And if we don't do that, are we ever going to see a 10 plus year type market develop? It seems pretty hard to see how that would happen if we're not actually accessing and utilising these markets to their full capacity in that 5 to 10 year bucket where we're hearing investors that they are comfortable in providing capital. And just the last slide, the transaction timeline. Your relationship bank should be talking to you about this. NAB does. We're out speaking to people all the time. And we start at the debt requirement, not product. So we're sitting there thinking about the businesses constantly talking about the debt requirements and mapping maturity profile out. And we love to understand, as I said, the cost versus benefit of longer tenor, the cost versus benefit of diversification. So you're going to hear questions from us around those types of things, because we are trying to map out a plan to go to the different markets if that is the desire of the corporate. Go into a structuring phase. The relationship banks will almost always assist with this in some capacity. We have a lot of competition from borrowers themselves and advisors who are doing pretty credible jobs at the moment. But ultimately, what a bank brings to doing one of these financing is a cornerstone in whatever your bank financing is, which is often very powerful in doing the marketing of that bank process, but also with the bond or loan investors, because having the bank that's originating that with skin in the game is of significant value to investors. Now, typically what we're seeing at the moment is the longer tenor execution happening first. Sizing the bank debt from the ability to access the longer tenor markets makes a lot of sense. So you can be, you can size your longer tenor transaction to the market's capacity or to your pricing outcome, and know that the bank market's there to backfill whatever the shortfall of the debt is at that point. Shorter debt, the smaller size debt for the loan for the banks clearly then creates more tension in doing that process with your banks and getting that refinancing done. So there is options. And the disclaimer.